Welcome to SmithWeekly Discussions, an occasional program for our readers and listeners of SmithWeekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. Before we get into our discussion today, we want to say thanks for the questions coming from our audience at SmithWeekly, including at Merman8562, at Plainview Danny, The Gravedigger, Sum Fleege, Philip N, Jacob L, Clarion J, and Andy F. We have on Rohan Reddy, Senior Research Associate of Global X Funds. Of course, Global X provides a number of ETFs on the U.S. markets. Rohan is one of the managers of the URA Uranium ETF. The fund is listed on the New York Stock Exchange under the symbol URA. Rohan, thank you for coming on.
Thanks for having me.
So, Rohan, I want to take a step back for a moment, and if you would, can you give the audience an overview of your background?
Sure. So my name is Rohan Reddy. I'm a research analyst with Global X. I've been here for close to 4 years now. And throughout that period, we've seen explosive growth in our firm in terms of assets and our breadth and reach globally. We are best known for our thematic, commodity-based, international, and our income funds. We have about $10 billion in assets as a firm, and recently, last year, we were acquired by a Korean asset manager called Murray Global Investments, and they bought it as a strategic investment, meaning that now we have the support of a large global asset manager to broaden our distribution reach and further resources in order to create intelligent and unexplored solutions like we have with funds like our Uranium ETF.
And Rohan, can you go into a little bit into your background before you came to Global X?
Sure. So this was my first job out of undergrad college. I did attend New York University, NYU, majored in economics, really sort of looked at Global X as a firm that was on the forefront of the ETF industry revolution, and decided that between the fit of the firm and my background that it could be a good fit, and so that's where Global X and I joined forces.
Okay, well that sounds great. I appreciate the information. So what are your thoughts on the uranium market today, and what's kind of your overall view of both the uranium market and where nuclear energy stands today?
It's an exciting time to be part of the uranium market today, and to evaluate it. But to be realistic, it has been certainly challenging over the past 5 or 6 years as a uranium investor. There have been brief pivots where the prices have done well, but then a lot of moments where the prices have come back to earth and they have witnessed declines. We do like the long-term growth story of uranium. One of the things that uranium, as a sort of a clean energy source does bring to the table is that as a lot of countries, and we saw this at the Paris Climate Accord a few years ago, many countries around the world are trying to explore cleaner alternatives to reduce their fossil fuel print around the globe. And so what that's done is that as a lot of countries are moving away from oil and gasoline and traditional sources of energy, they are exploring different solutions for that. And one of those has been nuclear-based sources of energy, uranium. And so we have been seeing this as a thematic story and a global macro structural shift where uranium as a commodity is becoming more and more demanded by the market based on regulations, political efforts, and also this need to kind of address climate change. And so we are pretty excited about the outlook for uranium, but just like any other commodity, it has been affected by the supply and demand dynamics. And so we have seen a lot of these powerhouse countries that do lead the way in terms of uranium production, namely Kazakhstan, start to look for solutions in order to reduce their production. And so we think ultimately the key catalyst that's going to be needed for the next few years is going to be balancing the market in order to support uranium prices.
And how do you see, speaking of supply demand fundamentals, looking from a global view, what do you see kind of as the kind of the next steps to see higher prices in the uranium market?
So from the supply side, this has arguably been the biggest driver behind some of the weakness within the uranium space. There's just been such great technological advances and a lot of investment in uranium over the past 10 years or so that it's become easier than ever to pull uranium out of the ground. And so to bring it to market is, a lot easier than it was before. Unfortunately, that's sort of flooded the market with a lot of cheap supply. And so what you've seen is that prices have fallen 60-70% since the end of the commodity super cycle. And so we think at some point, even though there has been this technological advance that has taken place, ultimately prices will need to revert back to some sort of long-term medium average. We don't think necessarily that it's going to go back to those days of what it was in the commodity super cycle back in 2010, 2011. But we do see some sort of normalized middle ground occurring, something in between what we're at now and what it was at that high point there. And so on the supply side, we are seeing countries like Kazakhstan take a lot of efforts, and companies like Cameco take a lot of efforts to reduce the amount of production that they're supplying to the market. If you think a few years ago, Kazakhstan did say that they were trying to reduce their output by about 10% or so. And then we did see a couple of key mine closures from Cameco. And so even though we have seen Kazakhstan to start this year say that they may increase their uranium production a little bit this year, these are still pretty monumental efforts in order to try and balance the market. And in some cases, these companies and countries have actually just outright come out and said that they're trying to, support prices a little further. On the demand side, I think the part of what's compounded the issue here behind the weakness has been the fact that emerging markets have not done well over the past few years. Currencies have gotten hit quite hard, and so purchasing power has taken a bit of a dive. Countries like China, which are amongst the biggest potential growth drivers of the uranium industry, have been experiencing both political, economic, and market weakness that sort of limited their ability to drive the uranium market from the demand side. And so as we see some of these issues starting to get resolved, we think that the demand side of the equation will start to come into play. You have seen, growth in nuclear reactors take hold, mainly out of China, which is really leading the effort there, but also globally, out of both developed markets and emerging markets. And so that's why we're excited about the future of the uranium market.
Yeah, I would say given uranium was at the spot price was around 136, 140 a pound back 2007, if memory serves me correctly, and it went back down to 18 in was it 2016, if I recall, if my numbers are right. So that's almost close to a 90% haircut. What's your view looking back into the U.S. for a moment? Tell us what your thoughts are on this Section 232 petition that's been brought by some of the U.S. producers. What's your take on that? And then also tell us what your thoughts are as far as nuclear energy within the United States.
So some of the efforts that, for security reasons have been brought about in terms of, limitations on that side, if these measures were to pass, and, we have seen this administration in the U.S. be pretty forward and out front about trying to be more conservative with the way they approach, uranium imports. This is an area that we think, similar to the trade wars and the tensions there, the worst case scenario is that this could have, somewhat of a deep issue within the overall uranium market in terms of the demand from the U.S. But similar to the trade wars, we think that worst case scenario is not going to be achieved, and there is going to be some sort of, middle ground achieved where both sides and parties get what they want there. In terms of growth out of the U.S., I think what we have been seeing is that even though international markets have been driving a lot of the growth within uranium over the past 5 to 10 years, especially with a lot of the publicity surrounding the move away from fossil fuels and into bigger countries like China and the nuclear reactors, I still do think that the United States will be one of the key players in terms of demanding uranium in the future. It has been muddled by this issue around security and some of the regulations and that section that you discussed. And so, ultimately, when we see a cleaner regulatory, legal, and political picture, we think that the long-term average or annualized growth figure is going to be somewhat larger than it would be right now, where expectations are not great because of the fact that these restrictions are coming into place.
Give us your thoughts on SMRs. What's your thoughts on how that might impact some of these advanced nations like the United States?
Sorry, could you define the SMRs?
The small modular reactors, for example, NuScale Power out of Oregon. There's a number, Rolls-Royce over in Europe. There's a number of different companies around the world that are exploring basically commercializing small modular reactors. And so essentially, if you go back and you look at nuclear submarines and the applications in military, going back 50 years, you pretty much had nuclear powered vessels, including submarines that had these small scale down reactors on a military application. But now there's a push for a number of companies to start looking at deploying these smaller scale reactors that can theoretically be built in a manufacturing facility and shipped to the site and consist of maybe, in the case of NuScale, a 60 megawatt plant. What's your thoughts on that? And do you see that kind of getting a grip and moving forward maybe over the next 5 to 8 years?
Yes, exactly. So yeah, I do think this, especially as the technology within the uranium space starts to improve, similar to we run a lithium ETF as well, where the technology behind that has enabled the size of those lithium batteries to be able to be put into things like cars and the power circuits and things like that. We think that as the technology does start to improve in the uranium space, along with a cleaner picture on the security side of how that's going to be regulated, that ultimately technologies like this that are uranium based can actually be extrapolated into areas like manufacturing, potentially even smaller power sources that may not need sort of a dirty energy source like an oil or something like that. And we think that eventually, as those start to get adopted, this could be something that could be a big growth driver for the industry. I think 5 to 8 years from now, that might be a somewhat aggressive time frame, given that the uranium market tends to move pretty slowly in terms of growth on the way it's sort of seen within the regulatory body's eyes. I think this is something where you could start to see much more of that scale come to market over the next, say, 15 to 20 years. And, similar to the way that autonomous vehicles have sort of transformed the vehicle space, which are sort of starting to take hold now, we think that this is going to be something that, if you look out 15 to 20 years from now, could actually transform the way that the uranium space is being perceived.
How about your thoughts on other energy forms competing with nuclear? When you look at the broad spectrum of coal and oil and nat gas and geothermal and hydro and wind and solar, when you look at all those, obviously they all kind of have a role and part to play at some point in energy mix. But what do you think the nearest competition or threat to nuclear is in the energy space, both looking at a country like China and also looking at a country like the United States?
That's a great question. It is one that we get asked quite often, which is the first part, why has uranium been slightly slower to adopt in some of these developed markets? And then what could be the potential threat to uranium as another energy source going forward. Part of why I think we've seen a slower adoption of uranium than has been expected over the past few years has been that oil and gas prices have been so low for so long. Part of, one of the ramifications of the shale revolution in the United States is that gas prices and oil prices, which are traditional sources of energy that have been used, are now cheaper than ever. And so the incentive to move to a different type of an energy source that requires a bigger upfront investment like a uranium isn't quite there like you would have expected it to be right around the time, when uranium prices were, say, 118 per ounce or something like that. We think that eventually as oil and gas prices do start to normalize, that you could see more of an incentive to move into uranium-based power sources going forward. But I think that's part of what slowed down this cycle. In terms of where we see sort of the bigger threats to uranium, I think the way it's being marketed and pitched right now to a lot of potential customers is, we can be your clean energy source for a fairly cheap price. I think the potential threat to that in the future could be other types of alternative energy sources like solar and wind. Those are the ones that I definitely have on my radar more so than others. The thing with solar and wind that's kind of kept them away from the uranium competition right now is that they are still relatively expensive compared to other forms of alternative energy. And so, it's part of why you haven't seen both the industrial and the retail side adopt it further, is just because of the expense, and not just the upfront expense, but the ongoing maintenance expense that it would cost to kind of continue using that source of energy. If those costs were to come down, and if you were to see aggressive subsidies globally or sort of kickbacks globally from the government to its citizens in other emerging markets and developed markets to say, hey, if you used solar and wind, we'll give you rebates on that. That's where you could start to see more threats to the uranium market. Is just, in terms of all else equal, which sort of energy source should we go with from a pricing standpoint? That's where solar and wind could come into play. However, I do think those concerns may be mitigated by the fact that we have seen a ton of upfront investment already been made by a lot of countries. There's not only a lot of nuclear reactors that are currently in place in terms of those that are in service, but we also are seeing a ton that are under construction. So China is probably, the world's biggest constructor of nuclear reactors right now. And it would be hard to envision them sort of, abandoning the growth prospects of that. And so I think as you start to see more investment being made, that will be more of an indicator that say, hey, even though solar and wind and biofuels and other types of other clean energy sources are competition, they may not have the same type of impact that they could have had this initial investment not been made by a lot of these countries.
So what's your thoughts on a situation where you have wind and solar is kind of really popular in the United States, but yet it doesn't quite solve the wind's not blowing and the sun's not shining, and the inefficiencies and the intermittent style of these two renewable sources in wind and solar, and then also the usable lives of these components and the maintenance, as you mentioned, that goes on with these types of energy sources. And then last, the sheer space consumption of solar and wind compared to what it takes for those to get anywhere close to a 1 gigawatt plant, nuclear plant that sits and produces baseload power. What's your thoughts on the ability of renewables like wind and solar to be able to replace baseload at the type of scale and sheer efficiency of nuclear?
Yeah, that's a great question too. So I'll give you, an anecdotal example of kind of some of the challenges that we've seen on that front. We do also run, as part of our sort of alternative energy suite of ETFs, we do run a yield co-ETF as well. A lot of the underlying energy sources as part of that yield co-ETF are in the wind and solar space. And the way this yield co-ETF was designed was that it was supposed to take part. It's an income vehicle, sort of similar to the master limited partnership side of the oil and gas space, which is it was pitched as an income vehicle that, was supposed to take part in this big growth in solar and wind. And, as those cash flows started to increase and people started to adopt it more, and, those concerns about prices and efficiency started to go away, and customers around the world were to adopt it, that the cash flows would start to rise incrementally to the point where this could start to be a stable dividend you could count on. Unfortunately, that didn't necessarily play out, partly because of the fact that there were these concerns in place. There were a lot of issues about, countries that were worried about, if the sun wasn't shining, if the wind wasn't blowing enough, would we have to support that with additional infrastructure to be able to continue powering, our energy? And so that sort of alleviated some of the issues for, investors who were thinking, well, if we can sort of not count on some of that there, then how are these governments going to, approach this space? And so what we did see is that the demand growth side of the equation hasn't been growing as much from that side on the solar and wind part as much as we expected because of some of these efficiency issues and pricing issues. I think in terms of, as you relate it to uranium and the way we think about that power source and the amount required to supply sort of like a nuclear reactor, I find it really hard to conceive that level of energy could be supported by a solar or a wind type of power source, just because of the amount of energy and time it would take and the efficiency needed that just isn't there today. Could it be something that, say, 20, 30 years from now may technologically advance to that point based on, scientific advances and stuff like that? Potentially. But I think based on where we are now, if you're looking at just, say, a straight nuclear reactor, that's an area where uranium is kind of in its own place in terms of having a monopoly on that side of the equation. That goes back to that point that we were discussing before. If these companies and countries start to make a lot of investment in those nuclear reactors, that's really a strong positive tailwind for uranium, because it basically is saying that these countries are committing themselves at least to some partial or maybe even majority use of energy in the form of uranium.
Okay. Well, yeah, I appreciate the comments on that. Well, I want to move on to some other stuff. Tell us about the URA ETF. Give us the total assets that are in place there, maybe the fund fees, and why you think that the URA fund is representative of the uranium market and also the nuclear industry.
Yeah, so it's the URA ETF that we've run. It's been around since 2010, has a pretty long track record. It has about 250 million in assets now. It is pretty representative of the way the uranium industry is constructed in terms of it holds both the miners of uranium, those who are actually producing it, but it also holds some of those nuclear power-based companies that are sort of exposed to uranium. And so, this is a pretty good side to be on in terms of it reduces the volatility that comes with, buying just those uranium pure play miners, and sort of as we've seen with the commodity super cycle and the move away from that all the way down to 18. What some of the issues that can arise with that is that a lot of these, they're sort of small cap and mid cap junior miners, is that they can be quite sensitive to the price of uranium. And so by including the rest of the value chain in terms of those nuclear reactors and end customers, what we do here is that we A, limit the volatility, but also B, are capturing sort of that full customer chain in terms of, who's actually buying the uranium and not just who's actually selling it at the spot or the forward price.
And what's the size of the fund right now, and what is the annual fee on it?
Yeah, so it's about 250 million in size, US dollars, and the fee is around 69 basis points. The fee relative to some other, broad market passive indexes might be considered a little high, say. However, This doesn't take into account the fact that a lot of these markets that we're going into are fairly illiquid markets, in which we have to buy up as the fund provider a lot of the underlying holdings in those local markets and sort of deal with the trading aspect behind it. And so we cover that as the firm, and that partly explains why the fee is slightly higher on the URA ETF. We have seen this used as a combination of a couple things. Our institutional investors are using it as a buy and hold strategy to take part in a lot of the themes that we've talked about on this podcast with the growth in the uranium industry. And then we have seen some of those traders who have shorter holding periods go into and out of the ETF opportunistically. One of the beauties of having URA in the ETF form is that this is one of the ETF industry's shining moments where the underlying markets are actually more illiquid than the ETF itself. And so the ETF is actually providing like a liquid sort of price discovery vehicle for investors who are trying to get exposure to the uranium theme and the rest of the value chain without having to actually go into some of those more sophisticated and non-U.S. domestic markets like in Asian markets or Australian markets and areas like that.
So Rohan, the AUM dropped kind of since kind of mid 18 or early 18. It dropped by a notable amount. Is this a reflection, do you think, on the sentiment in the sector, or do you think it's a result of the new adjustments and holdings approach by the ETF?
So a combination of a couple factors, both of them that you mentioned. So, I think one of the concerns on the fundamental side was that, as we kind of mentioned, that peak to trough move of uranium prices and sort of the power of some of those big miners like Cameco and, countries like Kazakhstan, if they were to ever change policy and, revert back to higher production levels. We did see Kazakhstan come out and say at the beginning of 2019 that they did, envision seeing higher production. That could potentially dampen prices on the uranium side, and so that could potentially, have somewhat of a negative overall effect on some of those miners within this space. It's possible that some of the outflows could be reflected on that side with some of the fundamentals.
Okay. Well, I want to make a few comments on that, and then I want to get into some other questions from our audience and some of the heartaches that they've had being in the sector and in the uranium investment community. I can kind of see that some of the components outside of the uranium sector, and that I mean producers and developers and explorers, but outside of that, you do have a couple physical funds that hold uranium, namely Yellow Cake PLC and also Uranium Participation. And then, of course, you have now Kazatomprom is listed in London, and you have Cameco, and you have even, I can think of probably maybe two other larger producers that have reasonable size for the fund, Energy Fuels in the United States, and of course Paladin in Australia. And then also I see that there are some construction components to it. I think Fluor Corp in the U.S. is one of those, and there's some construction contractors that deal with nuclear on that side. And then of course you have some of the utilities. Probably most of those you would probably look to the U.S., Exelion, Dominion, Southern, those companies. So I can kind of see how you might structure some of that side of it. The audience is curious to know if there is a way with your holdings and the restrictions, which I think it's possible, in my opinion, but I'd like to get your thoughts on it. Would the ETF consider going back to a pure play uranium ETF, or is that pretty much out of the cards? And if it is out of the cards, what do you think is kind of the allocation towards that uranium side of things? And that I mean, of course, producers, developers, and explorers. And would there be the option as you guys start to run up on some of these limits, 10% or 8% or 5% or whatever it may be, depending on where you're at, what company and what jurisdiction, wouldn't the fund have the leeway to be able to adjust holdings as those limits were approached to make sure that they stay in compliance And given the market is the total market cap of the entire sector for uranium probably consists of somewhere around 10 to 12 billion today, and most of that is Cameco and Kazatomprom. Obviously, as this market grows, which it seems like it could really only grow at this point, the market caps would improve, liquidity would improve, so that problem would probably start to go away as you got into a bull market. And so would the fund have the leeway to be able to sell some positions to make sure that they stay within those regulatory limits and just kind of readjust as things move? Well, we've got to ask you, Rohan, just to cover some of the audience questions. So we've got a knuckleball for you. Are you short the URA fund? I just wanted to ask. So on another topic, and again, looking at some of the comments that came across, and again, we've done, I don't know how much you know about us, but we've done quite a bit of work on the sector and have really done a deep dive all the way through it, fuel cycle and everything, supply demand, individual reactor consumptions, the whole mess. And some folks really got irritated when the pure play disappeared and some of the holdings readjustments that occurred more or less twice, and some of these rebalancing and stuff. And some of the folks were asking for your employment, and some of the other managers' employment. Don't understand why you guys are still have a job there. So you can kind of get a flavor for some of the people that are irritated about what's kind of happened with the ETF. And as you said, the ETF is a very large fund in this sector, and given we're at the bottom of this market, your guys' assets under management are quite substantial for this sector, and you can start to understand the liquidity issues that come with that. So as the uranium funds are coming into the sector, there's been a number of private equity and even some listed funds. I would just reference Geiger Counter in London. What are your thoughts on some of these funds starting to come in? I think there was another one, Uranium Trading Corp, which has not actually got there as far as a listed company yet. But what are your thoughts on some of these companies that are starting to take interest? And why should investors really consider URA over some of the alternatives like the physical funds and the public and private listed uranium equity funds?
Well, I think anytime you start to see other types of funds enter the space, that's a good sign. Anytime there's success within a market in terms of the ability to potentially profit in terms of either on the long or short side, that is going to bring about competition. And we do actually see in terms of the thematic growth side of the equation with the industry, that growth in the private side is really beneficial because it shows that longer term investors with longer holding periods, on the private side, it's not like, say on the public side or with a liquid ETF, that is locked in money that, is supposed to be there for years in time. And so that shows that there is confidence in the growth of the uranium industry. In terms of, why should investors put money into one over the other? I think it comes back always to the diversification. If you do want to be diversified and you want to invest mainly in a beta type of approach to uranium, the ETF or the diversified type of investment approach to it is, probably your preferred option because you're rather than making, an idiosyncratic bet on a company, you're making a systematic beta type of bet on the entire market. If you like one of the companies over the other, you probably want to go, with the private equity type of approach or direct equity in terms of, buying up that one type of stock of the company that you like. And so, we have seen both of those approaches be employed. And I think overall for the industry, as someone involved in the uranium markets and, in the investment community behind it, adding more options is always better than having less. We don't want to be the only game in town. We are, one of the few ETFs out there, and we do offer that type of ETF vehicle approach with the liquidity on top of it that doesn't come with the underlyings. But it's good to have, both that direct listing approach, the private side approach, the fund approach, maybe the physical commodity approach as well. And so what this allows investors to do is basically make their bet in terms of which way they want to go. And so I think what we've seen for our ETF is the growth on our side, has been for investors looking to make sort of a, broad market bet on uranium in terms of, how that market is going to be approached and perceived going forward and the growth of it. But if you do like certain companies and would like to add liquidity into certain companies and then take ownership and try and build it from the ground up, that's where the private side could come into place. We have seen a lot of money overall go into private equity funds in infrastructure as a whole, and that is a little different from uranium, but it just goes to show that a lot of money is going into these types of vehicles that are more longer term in nature. And so if that money starts to build within the uranium space, as you mentioned before, market cap right now, some of the public side is like 10 to 12 billion. If that starts to build going forward, you could see an industry really on the, flip side of the growth phase where it has a lot more runway to go.
Right. And I think last cycle, it was the total sector cap was well over 100 billion. I don't have the exact number in front of me, but it was quite a substantial move. And it's really interesting because it's a space that provides the fuel to the nuclear industry. And so while you and I both agree there's plenty of uranium around in the world, what there is a significant lack of is the ability to bring that out of the ground, put it through the fuel cycle, contract it, and get it into the reactors. That's where the bottleneck occurs, is that ability. And of course, that ability coincides with price. And obviously, you mentioned earlier the price is got to go higher, and that incentive price, from what we see, is certainly north of $50 a pound. In some cases, quite a bit higher than that. And then, of course, you got the recontracting debacle that's coming down the pipe, where you have a number of existing contracts that are coming off, and quite a substantial contracting cycle coming up in the next couple of years. And so it's going to be interesting to see how that kind of goes and how things start to look as things wear on, including this year with the Section 232 decision coming up here pretty soon. On allocation, I want to ask you about that. So would there be a consideration for the fund to have, say, 50 to 60% of its funds into the major big producers like a Cameco, a Kazatomprom? Even now, you can certainly look at Energy Fuels and, of course, maybe a Paladin, with exposure to some of the utilities that obviously make a lot of sense. I mean, the utility business is a little bit on the boring side for the investors, but there's certainly some options for publicly listed utilities. And then also you have the physical funds too that are fairly sizable for the fund to look at: uranium participation and yellowcake. And then maybe the last chunk of that, maybe say 30%, and I'm just using some rough numbers, but maybe the final 30% of that could be looking at some of the developers. Like, for example, I know the fund has NextGen. It has probably some other developers in the mix in the smaller holdings. And then, of course, you kind of break down into the explorers, which obviously some of those can be identified. And then maybe also cash as part of that mix. What are your thoughts on that, and how that positioning sounds for a bull run?
So yeah, I think anytime what we're trying to do here is not exactly reinvent the wheel. Basically, our approach is a fairly simple market cap weighted approach based on that nuclear exposed type of company side of things, and then the actual explorers themselves. I think in terms of having bucketing, if an investor did want that side of the equation, I think more of the active approach would be better for them. A fund manager who's looking at, the entire value chain of the business, but wants to allocate based on, where they might see better pockets of the market going in the future. The challenge for us in a passive index for that is that, just given that this market overall is fairly small on the public side of things, bucketing it according to, certain parts of the value chain and those trading type of vehicles and, funds and stuff like that, it basically kind of locks us into different position limits and categories. And that's kind of the area that we were trying to. It would potentially be better to kind of allocate according to the private side of things, having managers that might focus on the explorers, or some that focus on that nuclear side, others within the fuels part, maybe some utilities. And so I think that might make more sense for someone who wants kind of a bucketed approach. But our approach, just as a liquid, daily traded ETF vehicle, was to mainly just get the overall representative market cap of the nuclear and explorer space.
Does the fund have some consideration for secondary listings outside of New York? You had mentioned some of that foreign ownership at Global X and so forth. Is there any intention to have some secondary listings, say in Europe or Australia or Asia somewhere?
Yeah, I think we haven't, hesitated on some of our other funds of listing, in different markets. We've listed in countries like Mexico before, Colombia, other countries around the world. And so we haven't been opposed to the idea. I think what we have, needed to see in order to, cross-list them on different exchanges has been that there is necessary interest from the investors, and not just, a few kind of investors here and there that might want to opportunistically trade it, but actually have organic, investor kind of interest within this fund for longer periods of time. And so, a lot of the interest in our funds has come from Latin America and Central America, and so that's why we made the decision to cross-list in some of those countries. I think eventually in the future, as ETF adoption starts to pick up, which has been, one of the things I think that's kind of also in a beneficial way held back the AUM growth of the fund, just because of some of those illiquidity things that we were talking about before with the index. If eventually ETF ownership were to grow in, say, markets like Asia and markets like Europe, I think we could certainly explore cross-listing them in various markets. But I think one of the main things we do have to look out for is that overall investor interest for the longer term.
How about Kazatomprom? You guys are this is newly listed there in London. Is there any thought to add? You already have Cameco in there. Is Kazatomprom, now that it's listed in London, is that an option for the company to add to the mix?
Yeah, I would. Kazatomprom, just given that it's one of the bigger names out there in the space, up there with Cameco, I would expect it to be eventually added to the fund. The one requirement we do have, though, is having some form of trading history, given that it IPO'd in November. It has had a limited shelf life. We usually require around 6 months of trading history in order to add it to the fund. And so we do have semi-annual rebalances on URA. So I would expect that, once it crosses that 6-month marker, that it would be added at the next rebalance, because it's certainly big enough in terms of size and achieves the investment objective that the fund is looking to achieve.
So Rohan, how about outside industry expertise? So when the fund's doing research and looking at this stuff, does the fund look at is there some industry consultants you guys might use, or how do you kind of go about your research when you guys put together these names and you come up with this stuff to invest in with the fund? How do you kind of walk us through that?
Yeah, sure. So we do use Solactive as our index provider. Solactive is a company that we have a pretty good relationship with. We've licensed a lot of their indexes from them, given that they're pretty custom in nature. They're based out of Germany, and they help us out with a lot of, some of our non-off-the-shelf types of indexes that we create, such as a uranium. What we have worked with on Solactive is, given that some of these commodity-based industries that we deal with, such as uranium, do delve into certain markets that are kind of smaller in size and not as well publicized as other industries, like, say, oil or gold or stuff like that, they have actually been working with UX Consulting, which is a pretty big, industry leader in terms of researching within this space. And so when they kind of look at the overall investable universe during their rebalance periods, in terms of companies that are no longer in existence, or companies that now newly have been formed or now newly meet the index requirements. They do consult with UX Consulting in order to make sure that we have the entire scope of the universe. So we aren't just going about this from our end of things. We do have multiple other parties, Solactive and UX Consulting, that help with the construction of the index.
So with the frequent changes in the fund that's occurred, there's been, as we mentioned before, some concern with folks, and the fund. Some folks have said that the fund is starting to represent less and less of what they're interested in. Is there a real drive to create a high quality ETF at this stage in the market cycle for uranium that expresses the sector in the right way? Maybe you can clarify for the audience, or is the fund just kind of serving a little bit of demand for liquidity and really just kind of collecting a fee? Yeah, and I would just say that most of our audience at this point has been in the sector, been looking at the sector pretty heavily, probably since 2017. And so the group that we have generally is probably much higher educated than, say, a general person who had just turned on CNBC and heard a word about uranium and had no clue about how the cycle worked or anything related to market timing or any of that. So I certainly, the community that we have certainly is well informed of kind of what's going on, which as you get to that level, you tend to drive down into setting a strategy that is really kind of set to outperform what an ETF can do. And so obviously, as you become more of a highly knowledgeable in one sector, such a small sector as uranium, you can start to adjust your strategy to really maximize the situation that exists. I want to take just a step back for a moment and talk about kind of broad ETFs. Tell us your thoughts about that. Are you of the opinion that ETFs are kind of the future and kind of the way to go, or are ETFs set up to kind of serve a public vehicle that really is for investors that are maybe less informed, maybe want to take less risk, that think that ETFs might be the way to go? How do you see the ETF market going forward? Give us your thoughts on that and how people might approach that, and what your thoughts are about ETFs, and if ETF is maybe something that only you only use ETFs, or do you look at individual stocks as well?
So yeah, I mean, the growth of the ETF industry over the past 15, 20 years has really stemmed from a couple things. Number one was the mutual fund structure and some of the inefficiencies within mutual funds. The second thing was fees. A lot of investors have just grown tired with paying high fees to fund managers that in a lot of cases have underperformed benchmarks. Part of the growth in ETFs that we've seen has been because of the fact that in a lot of cases, mutual funds have been the only game in town. For U.S. investors, mutual funds have been around for their entire lifetime. And so it was the structure they got used to the most. I think a lot of investors have been left with a bad taste in their mouth because of some of those big capital gains distributions that can get paid at year end during bull markets. And also the fact that, you have seen a lot of high paid, underperforming managers start to become pretty prevalent throughout the space. And so as a result of that, you're starting to see between fiduciary rules that financial advisors have to undertake, and then just broad fee compression within the overall universe, you're starting to see ETFs become more and more popular. I think the area that we do envision a ton of growth in for ETFs is that self-directed retail platform, but also out of financial advisors, high net worth individuals, and then the European and Asian markets, which they've been a little bit more behind on the curve in terms of their adoption of mutual funds. So given that they're starting to buy mutual funds, now all of a sudden ETFs are starting to compete with those mutual funds. And so they're kind of a little bit more ripe in the process to be educated about ETFs and consider it as an investment option. I don't necessarily think that ETFs are, for a less sophisticated investor who wants to take less risk. It is for an investor who, is concerned about tax inefficiencies, liquidity, wants to be able to, instead of having to deal with that non-tradability that the mutual fund structure comes with, they want to be able to control their own destiny. and be able to do so in a manner in which, they're conscious about fees as well. I think that's, taking a broad step backwards. That's kind of why ETFs have really grown into close to a $4 trillion industry, that's about a third the size of what mutual funds are. But I eventually would, forecast that they will eventually overtake mutual funds in terms of size of assets held under management. In terms of personally myself, I do think the ETF structure is, I use it in my own, personal investing side. And then I also think in many cases, it is the preferred vehicle for investors to access a space. It is being used a lot in a lot of different ways than it was so before. I think you're seeing a lot of alternative investment strategies get packaged into ETFs. Active ETFs are also starting to become big. And then you're seeing, take our uranium ETF, for example. Previously, these are stocks that would have been bought by mutual fund managers on a one-off basis within a fund. Now we kind of offer that as like a beta access strategy. So that's kind of where you're seeing the growth of the space going forward. It has taken on a lot of hair in terms of the different strategies that are being offered out there, and how it isn't just plain vanilla beta access, but now it's kind of going into different industries like fixed income, alternatives, hedge fund replication strategies. And so there has been a pretty big growth in due diligence happening across the space at a lot of, wirehouses and banks and, within the retail investment platforms. And so the other thing that's also been helping is that there has been a growth in commission-free trading on platforms like Schwab, TD Ameritrade, Fidelity. And so this has enabled the retail investor to, again, access an investment that they want to, that they can control at an even cheaper manner than they, were to have been able to, say, 10, 15 years ago.
I think they have a place in the investment world. I don't think they're everything, but I think they certainly have a place, and they'll certainly be around, and they're there to serve certain purposes, certainly. And so I think it's a good thing to have around. I hope the market doesn't go 100% to ETFs, but I don't think that'll happen. But certainly it has some uses, and I can see kind of both sides of it. So one other thing, moving to holdings for just a second, I just want to ask you this because it's kind of an odd duck. What's Barrick Gold doing in the holdings?
So yeah, we have gotten this question, not just in our uranium funds, but also some of our commodity funds. The question has been, if a company has exposure to a type of commodity like a uranium, even if it's only a small part of their revenue, but they're still a big producer of it on like an absolute nominal basis, should they be included? And so because Barrick Gold, has a little bit of exposure to it, that's why we have added it, even though, it is primarily kind of a diversified gold mining type of company. So, again, this goes back to the liquidity side of things and, kind of behind how do we access a space without kind of diluting the effect there. I guess it does add liquidity to the fund, but does also come at the expense of, well, it's only a smaller portion of the revenues. So, overall, I think it is representative of the industry, even though it might kind of strike someone as being like an oddball holding, but, it does bring up the other side of the equation, which is, investors could ask, well, Barrick Gold on a nominal, amount could be considered a decent sized producer. I guess why isn't it in the fund?
Okay, well, yeah, I certainly like Mark Bristow and team, but for purposes such as gold, whereas the fund has BHP and Rio Tinto, which obviously provide much more of a uranium byproduct in their operations, more so than Barrick. So I would think that those two global giants, BHP and Rio, would be sufficient. So one more time, Rohan, let us know, why should investors be taking a stake in the Global X URA ETF? What would you say to potential investors listening?
I would break it down into two buckets. So the first bucket, if you're a trader, which is, we have seen a decent amount of assets come in from that, trading side who are looking to get in opportunistically, have shorter holding periods. It still does represent the beta that you're kind of looking for if you're looking to make a directional market bet. Like, if you envision uranium prices going up, but you don't necessarily want to buy the uranium spot commodity, this could be an interesting way to play it, and it'll give you kind of, the outlook and the returns that you may be looking for, not kind of that direct leverage side that you may have previously seen with, just the explorers, but directionally it'll get you kind of to the place you want to be. That's kind of the way it's approached with a lot of these sort of commodity exposure equity funds, which is, if you want to make a bet on the type of commodity direction that you think it's going to go, then it could be an interesting way to make a bet in the ETF or kind of the mutual fund structure based on that. If you're a longer term investor, we have had a lot of success at attracting longer term investors into this fund, mainly because that theme of clean energy, alternative energy, potential sort of ESG guidelines has resonated with a lot of people who are looking to move away from certain oil and gas and fossil fuel and coal type of exposure. This is a group that, they look at kind of the growth in nuclear reactors and the production of uranium and sort of, the policies that different countries are putting into place. And they definitely see the long-term merits behind holding this for a 5, 10, 15-year period because, could it, from a thematic and structural standpoint, given that it's disrupting the traditional fossil fuel industry, potentially outperform that segment of your portfolio over that period of time. And so, if you're an investor who's saying, well, I previously have held oil and gas in my portfolio, but now maybe I want to be a bit more, concentrated in terms of where I actually put my money from, an energy standpoint. Maybe I want to look at those cleaner side of things. That's where we've also seen investors carve out a portion of their portfolio and move some money away from oil and gas and into the uranium side of things.
So how can investors reach out to the URA fund for more information?
So you can go on to the www.globalxfunds.com website. We do have research on the space. The fund page is the URA ETF fund page on our website. It has the fact sheet, investment case, research that we've done behind it. And then you can also explore the index methodology and different information on that. In addition, we also do have a contact us line in which investors can reach out and have their questions answered by members of our team.
Rohan, thank you for taking the time today. We look forward to watching the fund and the sector going forward.
Absolutely. Great speaking with you.